2023 is going to be a unique year for our economy. For one, there's a pretty high probability that it's going to be declared that we are in a recession if we're not already in a recession right now, which isn't really news. More people than ever predict that we're already in a recession or going into a recession. So that's not the important part. The thing that I want you to understand is going to be the impact of higher interest rates being absorbed into the economy. Now, we already know these sensitive areas, like in the housing market. When interest rates go up, less people buy homes. When interest rates go up, it affects your credit card debt. That's the obvious part. But what about the not so obvious part? Because in 2022, we saw a drastic run up in interest rates, but we never really saw the real effect of the absorption rate of these higher interest rates in our economy, because it takes time for the higher interest rates to actually get absorbed into our economy. And now the interest rates are significantly higher today than where they were in the beginning part of 2022. And with the Federal Reserve Bank saying that they're going to continue raising interest rates into 2023, what does that mean for our economy and for your wallet? The first thing that I want you to understand, because the entity that is going to feel this very significantly are going to be startups. Startups run on other people's money. That's just the way that the startup environment has been for especially the last few decades, because you have an idea and you want to get it to market, and the fastest way for you to get it to market is to go and raise debt or to go and raise venture capital. Well, raising debt has become significantly more expensive because interest rates are so much more expensive. So people turn to venture capital firms and banks and institutions to get investment dollars for equity. Well, these venture capital firms and institutions also borrow money. And over the last number of years, they've been able to borrow money for essentially dirt cheap. And because they were able to borrow huge amounts of money for super low interest rates, they were having all this cash and they needed a place to dump it. And so they were dumping this money into startups. And this created a huge boom of startups, especially in the last few years. And so you saw this huge run up in startups who were able to raise money at insanely high valuations. In 2020 and 2021, valuations went through the roof for startups, even into 2022. But in 2022, we started to see these valuations drop. And now, especially into 2023, you are going to see many more startups start to struggle, because they're going to be forced with the decision that if they cannot continue raising money at the same high valuations as before, they're going to have to become profitable, which means they're going to have to change their business model, because most startups are not profitable. What are you doing? You're trying to get your product to market as fast as possible, so you don't want to have cash in the bank, because cash in the bank could be used for advertising, getting more customers, getting more users. And right now, we are seeing many startups face this crunch where investors are saying, we need you to make a profit. And some startups will be able to make a profit, but others will not. And many of them, if you cannot make a profit, will try to get acquired, meaning bought out by another company. But if you can't get bought out by another company, then you're going to fail, meaning you're going to see more startups shut their doors. This is something that will happen in 2023, that startups who relied on this outside capital are going to have a significantly much more difficult time to raise this type of outside capital, because you're not going to be able to raise debt at any affordable rate. Banks are not lending to startups the way that they did before, and institutions are not investing their money into startups the way that they did before. So this is something that you need to be aware of on the startup side, because if you are affiliated with these types of startups, well, you're going to see many of them get hurt in 2023. The second thing that you have to understand is how interest rates are going to affect employment and compensation. Because it's pretty obvious that we've been seeing way more layoffs happen in the second half of 2022, because now we've been seeing tech companies do these layoffs as a way to now start cutting costs, because they've been so overbloated, so over-leveraged, and now they have all these costs and they're not making as much money because companies are not spending money in advertising. So tech companies are struggling. So they're laying people off. And we're going to probably continue to see these layoffs into 2023. But there's a lot of people saying that these layoffs are just exclusive to this tech sector and it won't bleed off into other sectors. But I don't want you to believe that, because there's a very high chance, a very high chance that you are going to see more and more layoffs, not just in tech, but in other sectors. So startups who have to shut their doors, people will get laid off there. The big tech companies who became overbloated with the super high valuations of the last couple of years, they have to do their layoffs. But eventually, if the higher interest rates continue and the economy continues to slow down, you're going to see more non-tech companies perform layoffs because they're going to be facing the same issues as tech companies. And this also affects compensation because there's a lot of industries out there like banking, engineering, especially on the tech side, where your compensation is tied not just to your salary, but the company's performance. So you get bonuses, you get additional payments from something that's outside of your salary. And there's a high chance that you're going to see these bonus and performance-related compensations get really hit or completely wiped out in 2023 because of high interest rates. We're already starting to see this happen. We're starting to see this happen in the banking sector because the big banks are not able to lend the way they were before. We're not seeing the same investment gains that they were before. And so the investment bankers who were relying on their bonuses and these big checks, well, those aren't happening the way that they were before. And if interest rates continue to go up, and if they continue to stay high, these performance-based compensations are going to impact people's salaries and their income. Why does this matter? The reason why it matters is not so you feel bad for a rich investment banker. The reason why I'm saying this is because you have a lot of people who changed their lifestyle over the last couple of years based off of this income-based compensation. So realtors, lenders, investment bankers, certain engineers, people who get paid based off of a commission or some sort of bonus. You saw a lot of people, I've seen this especially in the realtor, the lending space, because I know a lot of people in this space who made a lot of money in 2020 and 2021 because of this economic boom. And they started changing their lifestyle. That means driving nicer cars, got a bigger home, started spending a whole lot more money because they were making a lot more money. Well, if in 2023 that income goes down and you have expenses way up here because you have big car payments, big housing payments, big whatever payments, well, now you're going to have to find a way to keep making these payments even if your income goes down. And many times we assume that when things are going up, that they will always continue to go up. Well, the party's ending. And we're going to see more and more people who are tied to this performance-based compensation see a hit in their income. And if your expenses are extremely high, well, if you're watching this video, I would recommend starting to cut those expenses sooner rather than later. That way you can protect yourself, because you're going to see more and more people start to struggle in that situation, which then has a trickle-down effect into the economy. So there's a lot of predictions of people saying what's going to happen in the economy. It's impossible to predict, but I want you to be aware of what's happening. That way you can make smarter decisions with your money. That smarter decision today is reducing your expenses, because the reality, based off of everything that we see around us, anybody with any sort of financial sense should understand there are red flags in the economy right now. What do these red flags mean? Is it just something that's going to bypass us, hopefully, or is it something that's going to smack us in the face? Well, we don't know what it's going to be until it hits us, but what we do know for sure is that there are red flags out there. So be smart with your money. Have smaller expenses. Live smaller right now. Maybe things blow by. If they do, then go out and buy a nicer car, have a bigger home a little bit later. No big deal. But if things smack us in the face and you have that extra cash, well, now you have cash to protect you and you have cash to buy investments at a discounted price. If you don't prepare and we get this economic slowdown just blow by, well, now you're okay. But if you don't prepare and this economic slowdown smacks us in the face, well, now you're the one that's going to be paying the price. And that is the worst case scenario, where you don't want to be the person who is paying that price. Understand what's going on in the economy. Understand that it's going to affect companies. If you're working with these startups, if you work at these startups, look at what is going on behind the scenes. Talk to them and be aware that we can take care of yourself, because 2023 is going to be impacted by the higher interest rates as they get absorbed into the economy. And while no one can perfectly predict what's going to happen, we see the red flags. That way you can make better decisions with your money. Now, of course, we keep you up to date every day with Market Briefs, which is my free financial newsletter. If you haven't joined Market Briefs yet, I'll put the link to how you can join down in the description below. If you're not interested in investing in individual companies, if you're not willing to spend the time doing that, because I think the majority of people should not be investing in individual companies because they're not willing to put in the time, effort, research, and have the psychology to do that, then you can just look into an ETF that gives you exposure to the general stock market, the S&P 500, which is the biggest 500 companies on the stock market.